Most people think you need millions of dollars to retire on dividend income. They think you have to wait for quarterly checks or, if you're lucky, a monthly payment that barely covers the electric bill. But what if I told you that in 2026, the financial landscape has fundamentally shifted? You can now start receiving a paycheck every single Friday, starting with as little as $100. Today, I'm showing you the low-stress way to get paid weekly, using safe, government-backed ETFs that most investors are completely overlooking. Now, before we get into the tickers, you need to know that this is part one of a brand new three-part series. I've spent months analyzing the 2026 market, and the landscape is no longer what it was even 2 years ago. Monthly dividends were the gold standard for decades, but now we have the specialized tools to build a literal weekly cash flow machine. But here is the real wealth hack you need to hear before you spend a single dollar. You might have seen older videos or blogs talking about weekly ETFs, like TGIF or WKLY. If you go looking for those today, you won't find them. They were closed down and liquidated because they couldn't survive the market shifts. This is exactly why you need to stay glued to this channel and subscribe right now. The income chase moves fast. If you aren't following the most up-to-date data, you're going to be left chasing ghost tickers that don't exist anymore. By the end of this three-part series, you'll have a complete blueprint for a three-tier portfolio. Today, in part one, we build the foundations, safe, sleep well at night ETFs. In part two, we level up to big tech weekly ETFs, where companies like Nvidia and Apple pay you every Friday. And in part three, we go for the high-octane yields, where we're talking 50 to 100% payouts for the risk takers. Let's build your first weekly paycheck.
Why move from monthly to weekly? Is it just a gimmick? Absolutely not. It's about solving the biggest problem for American retirees: sequence of return risk. For investors in their 40s, 50s, or already in retirement, the biggest danger isn't necessarily the market going down. It's being forced to sell your shares when they are down because you need cash to live. When you get paid every Friday, you stop being a victim of market volatility. You aren't liquidating shares to pay for groceries. You are living off the rent your capital is paying you. Then there is the compounding speed. Every day counts. In a high-interest environment, reinvesting your dividends every 7 days instead of every 30 means your capital is put back to work significantly faster. Over a 10 to 20-year horizon, that extra frequency can add thousands of dollars to your principal balance through the sheer force of math. But we must start with the foundations. Many people jump straight to the 50% yield funds and lose half their money in a month. We aren't doing that here. These Tier 1 ETFs are where your principal is essentially protected by the US government. These are the funds that provide the floor for your lifestyle.
Our first foundational ETF is the Roundhill Weekly T-Bill ETF, ticker symbol WEEK. As of February 2026, this fund has solidified itself as the gold standard for weekly cash. It holds an actively managed ladder of US Treasury bills with maturities between 0 and 3 months. Treasury bills are backed by the full faith and credit of the US government. They are widely considered the safest investment on earth. When you buy weak, you are simply collecting the interest the government pays to borrow money. The current yield is trending around 3.5% to 4.1% annually. The payout frequency is every Friday, and the expense ratio is 0.19%. A 0.19% expense ratio is incredibly lean. For every $1,000 you invest, you're only paying $1.90 a year for professional management. Roundhill handles all the daily buying, selling, and rolling of these T-bills, so you don't have to manage a bond ladder yourself. If you put $50,000 into week, you are looking at approximately $35 to $40 every single Friday. That might not buy you a Ferrari, but it covers a utility bill or a tank of gas, and you know with 99.9% certainty that the money will be there every Friday morning. Next on the list is MMKT, the Texas Capital Government Money Market ETF. This is a unique tool that every serious income investor should know about. It is the first ETF designed to comply with SEC Rule 2A7, which are the strict rules governing traditional bank money market funds. It invests 99.5% of its assets in cash and US government securities. The 7-day yield is currently around 4.05%, with an expense ratio of 0.20%. Think of MMKT as your emergency fund on steroids. Unlike a traditional bank account where you might wait a month for interest, MMKT pays you every Friday. If the S&P 500 drops 10% in a single week, MMKT likely won't move an inch. At a 0.20% expense ratio, this is where you park the money you cannot afford to lose, the money for next month's mortgage or your property taxes. It keeps that Friday ping happening on your phone while keeping your principal ready for any market opportunity.
Now, let's talk about a brand new player that just hit the market in January 2026, TLDR, the Rex Ladder T-bill DTF. Rex Shares is the same innovative company behind some of the most popular income funds on the market. With TLDR, they are targeting investors who want to maximize the yield from the front end of the Treasury curve. It holds T-bills with maturities generally under 6 months, slightly longer than weak. The projected yield is matching high-end T-bill rates, roughly 3.8% to 4.2%, with an expense ratio of 0.2%. Why would you choose TLDR over weak? Because it is actively managed, the fund managers can pivot the ladder as interest rates change. If the Fed signals a rate hike, the TLDR team can adjust their holdings faster than a passive index. It's a slightly more modern take on the T-bill ladder. If you want to diversify your foundational holdings, splitting your cash between weak and TLDR is a very smart move.
Finally, for the last foundational piece, we have TSYW, the Roundhill Treasury Bond Weekly Pay ETF. Now, I want to be very clear. This is still a treasury fund, but it is not as low stress as the others. TSYW is 1.2x leveraged. It aims to provide 120% of the weekly return of long-term government bonds, essentially the TLT ETF on a bit of leverage. The yield is around 2.9% to 3.2%, but the expense ratio is much higher, at 0.99%. Long-term bonds are extremely sensitive to interest rates. Because this fund is leveraged, if interest rates go up, the price of TSYW can drop faster than a regular bond fund. This is for the investor who wants a weekly paycheck, but also wants to bet that interest rates will go down in the future. At a 0.99% expense ratio, you are paying a premium for that leverage. I recommend this as a smaller satellite holding to your main foundations, like weak or MMKT.
Now, we need to have a serious talk about the IRS. Weekly dividends are a massive win, but you have to be smart about how you hold them, or you'll lose your edge. First, ordinary income. Because weak, MMKT, TLDR, and TSYW pay out interest from government debt, these are considered ordinary income. They are not qualified dividends. This means they are taxed at your regular income tax bracket, which could be as high as 37%, not the lower capital gains rate. Second, the state tax secret. Here is a major real wealth hack for my viewers in high-tax states. Since these funds are primarily comprised of U.S. Treasuries, that income is generally exempt from state and local taxes. This makes your effective yield much higher than a standard high-yield savings account or a corporate bond fund.
These 4 ETFs, weak, MMKT, TLDR, and TSYW, are your floor. They provide the safety, the liquidity, and the consistent cash flow to cover your basic lifestyle needs. But I know why you're really here. You want the big checks. In part 2 of this series, we are leaving the government safety net behind and moving into big tech income. I'm going to show you how to own the S&P 500 and the NASDAQ 100 through ETFs like QTDE and XTDE, and how to force the Magnificent 7 to pay you a weekly dividend that makes a 4% yield look like pocket change. We're going to talk about zero DTE options and how to turn tech volatility into a weekly salary. Comment below. Are you a monthly loyalist, or are you ready to switch to weekly after seeing these foundations? I read every single comment, and your feedback helps me build the next script for you. If this deep dive into the 2026 weekly market helped you, give it a thumbs up. I'm your host, and this is The Real Wealth Hack. I'll see you in part 2. Keep investing simplified.